Hello, and welcome to another episode of the AI Cash Grain podcast. Today is August 9th. I'm Satish Nandapurkar, Director of Data-Driven Strategies at Quantum Hedging. In this episode, first we'll go to Cy, and we've got almost a broken record here. Corn continued to slide. Soybeans continued to slide. Corn was down 8 cents, closing at $3.95 for the week. Soybeans were down 25 cents, closing at 1,002.5 for the week. So, Cy will take us through what's going on. Again, it's probably some combination of weather and just the market looking for demand at this point, with a lot of supply expected. But we'll go to Cy and see what's new and when this slide might stop from the trader's point of view. Then we'll go to Kevin. Kevin will talk about what the models are saying. Models are pretty much saying the same as last week. The models were neutral last week in both corn and beans, and they are neutral again this week. That doesn't mean we won't go up or down. It just means the models aren't picking up on anything that tells us with good conviction that we should be going up or down. So the models are just kind of neutral, saying the data is neutral as of right now. And as a result, our simulations, when we look at our forecast combined with our simulations, they're telling us to hold. We're sitting here at August 9th, and we're 60% sold in corn. We're ahead of the game. We're beating our benchmark. We're about 5% oversold. In beans, we're right on the benchmark. We're 55% sold, and we're ahead of the game. We're beating the benchmark. So in both cases, the models and simulations are basically saying, don't have a lot of conviction right now. We're ahead of the game. Keep it fairly neutral. Don't do anything and wait for more data to come in. So with that, I'm going to turn it over to Cy. Cy, what's going on here? Will this slide ever stop?
Thanks, Satish. Yeah, the fundamental news really hasn't changed. The market's now talking about a 185 national corn yield, and it sure feels like it. The weather's been really good. I think what happens now is the function of the market continues. We've been talking about this. This is what traders are talking about. Is the function of the market is to go find this demand. And I think over the next 30, 45 days, what happens is it's going to go down, find that demand, and see if there's a bottom forming, right? And then you kind of get into the new year, looking at wheat, looking at global supplies, seeing if there's anything bullish on the horizon that can cause a shock to the market. As of now, that doesn't seem to be the case. Now, I will say, looking at beans, the market that's got a potential bull story out of everything really is soy oil. So you got a large spec short, you got a bunch of fundamental news coming on for soy oil that has a potential to kind of spark this market. On the backside of that is a meal market that processors ramping up their production, and I think you could see a long oil short meal story sparking up here, but maybe not yet, maybe not for another 30 days. So as of right now, if we get a bigger bean break, I think, you go down to 950, 9.25, maybe that's enough with this soy oil story looming in the background. Kevin, our models saying anything for corn or beans?
Thanks, Cy. I appreciate the discussion about the markets. And, this week we're waiting for USDA's report on Monday to kind of talk about the first yield data that's coming in from an objective survey. And, this week we also kicked off at Quantum Hedging our Weather Wednesday segment. This will be a new segment we do every Wednesday. You should see it in your Thursday morning weather email. And the idea of this Weather Wednesday is that we're going to dig into a little bit of weather data and figure out what is the association, correlation, causation between weather metrics and identifiable market factors such as yields and prices and things like that. So this week we talked about how extreme years of bad yields for U.S. corn or record yields for U.S. corn could be tied to one really kind of key statistic. And that key statistic is highlighted in yellow on this screen, and that is the number of times of the year and the area of the U.S. growing region where we see 90 degrees or more during the growing season. And so this happens to be a snapshot for the last 20 years, showing the 4 worst yield years on the left, bad yield years, and the 4 best yield years on the right. And what was the numbers, those metrics from the corn area that was greater than 90 degrees? And you can see in the 4 years where bad yield years happened, quite a high incidences of either the number of days or the area that was covered in the US where temperatures were greater than 90 degrees. So on average in these 4 years, you had a metric that was around 28.1%. In those bad yield years, you also had 7.9 inches of precipitation over that 2.5 month period from June to August 15th. Now, conversely, take a look at the right-hand side table. This is the record yield years. This is when yields actually set new records, and we see how much those particular years improved yields over the previous record. And what you'll notice quite strikingly is that corn area greater than 90 degrees is really small, only about 9% on average. And also you'll see precipitation was 9.7 degrees or 9.7 inches, which is again above the 7.9 inches that we see in bad yield years. Now for 2024, here's where we see where we're at as of the forecast through August 15th. Slightly higher than normal for record yield years, with corn area greater than 90 degrees being 15.5%, but potentially offsetting that higher than normal temperature above 90 is better than normal precipitation in record yield years. So we see 10.4 inches of precipitation has fallen. And that's kind of what you've seen in your weather email. It's been kind of a hotter than normal summer and also a wetter than normal summer. So how do we stack this up? Well, chances are we'll see something close to what USDA has already on the books for a 181 corn yield. In terms of our markets and models, markets have been following kind of what we have been saying for much of the growing season. We are now firmly below $4, closing on Friday at $3.95. And not much of an optimistic hope that we're going to see any sort of major recovery. Maybe a slight blip higher. Our model does have some potential for a little bit of a bounce, but don't get too excited about what that bounce could look like. Even the extremes at this point are really starting to contract, where our extremes are really 350 to 430. And again, our kind of baseline target for the last half of the part of the growing season into September, October, somewhere in that 380 mark. So that seems to be kind of where we're heading as we move forward. For beans, not much here also to hang our head on. We are still slightly above $10, but that could fall next week. And again, our model just doesn't give us much optimism for things to change much between now and then. The range of trade for the next, call it 2 months, is expected to be between 940 and 1070. So that's kind of where we're at. Satish, what are you seeing from your side?
Thanks, Kevin. So let's, again, I mentioned with recommendations, let's talk about recommendations that we have a hold. That's our recommendation for both corn and beans. And again, I always start the recommendation section reminding everyone that our goal is to beat our benchmark. It's a predetermined strategy of selling an increasing percentage of expected bushels each month, January through October. Currently, as of the end of July, the benchmark was 55% sold in both corn and beans. So our approach is to take what our models are telling us, take the conviction, the confidence that the models have, and use that to simulate out different outcomes by being oversold or undersold. Right now, as we go through the different recommendations, if you look at corn, we are a little bit oversold. So the index is 55% sold. We're 60% sold. So we're just barely oversold, and we're sort of holding that position. We had some good calls because at the end of May, we got way oversold. Right as the market was about to come down, we cut back on that oversold position based on the data from the models and what it meant in our simulations. Now we remain about 5% oversold. The simulation is basically telling us mid-month, hold, don't do anything. We just sold 10% on July 31st. Yes, we've got a slightly bearish stance with that 5% oversold position. It's working out as we keep going lower. And if we stay right about here, we're tracking to almost a 10-cent outperformance versus the benchmark by the end of the year. So, our goal was to beat the benchmark, and we should come in about 10 cents better than the benchmark for corn, which is great. When it comes to beans, Right now, the benchmark is similarly 55% sold. We're also 55% sold. Neutral stance. We sold 15% on at the end of the month, July 31st. We have no deviation, so we're kind of neutral versus the benchmark. So we won't pick up any outperformance until we deviate. And right now, the models and the simulation are saying don't deviate. We are ahead of the game. Our average price is almost 11.29. The benchmark is about 11.20, but when we average in the remaining 45% at around this level, we should track to about a 4.8 cent outperformance, almost a 5 cent outperformance versus the benchmark at the end of the program. So a good situation for both corn and beans. Last week, I talked a little bit about seasonality and what seasonality was saying from August 2nd out for both corn and beans. I thought I should step back and just talk about overall seasonality for corn and beans. Um, when you take a look at what corn and beans typically does in a crop year, what we've done is we've gone back and averaged 30 years of what corn and beans has done, starting at around end of July of the previous year. So, think about starting now and going all the way forward for 2025 until the end of October. So, is there a pattern when you average it all out? You average the years, the last 30 years, and you say, let's start in the middle of the previous year and then go all the way through the crop year. What's the pattern look like? Both corn and beans have some pretty good seasonality. I mean, look back here. This is the equivalent of July 1st, right? So you start at July 1st. Corn goes kind of sideways until almost until the beginning of December. So you're talking about for now, it'd be for crop year 25. Typical seasonality is corn goes sideways until the beginning of December for next year's crop, not for this year's crop, but for next year's crop. Then the future starts to climb, right? We go up about 2%, 3%. By the time we get up here, this is actually the first week in June. This is a pretty bullish period. So from the first week in December to the first week in June, we've gone from 99 to 104. So that's about a 5% climb, right? Most of it happens pretty much in here up until call it uh, the beginning of April. But you have a nice climb all the way up here. And then look at this seasonality. When you look at the seasonality of corn from around the first week in June all the way till about the end of September, man, that is quite a drop. You're dropping from 104 to 95. That's a 9% drop. That's averaged over 30 years. When you look at the statistics, we've only gone up 30% of the time in that period. We've gone down 70% of the time. And then you get a little bit of recovery in October. So you drop all the way from the beginning of June all the way down to the end of September. And then finally in October, corn has a little bit of a recovery at that point. But man, this seasonality is just crazy. Everybody gets bullish here, but history says everyone shouldn't get bullish. There's something happens with weather, something happens, with a drought, something there that gets everyone bulled up, and then the rug just gets pulled out from underneath them. And that's again a 30-year average. When you look at soybeans, it's a little bit different. Similar. You have starting now in the middle of the previous year. So now we're looking at, Nov 25 beans, not Nov 24. Seasonality looks different, but Nov 25, here we are. You go kind of sideways again, but from about November 1st, we have this steady climb. It's just kind of a steady climb from November 1st till the beginning of June. This is not every year. This is the average of 30 years. When I average out 30 years, this is what you get. Looking at weekly data, you get a climb where we're going from around, call it 100, till about 106. So we're going up about 6%. We get a drop. It's not as severe. First week in June to here, we're probably down about 5.5% versus corn that's down a lot. It's close to 9%, right? So you get that same seasonal play and then a recovery in October. So again, it's not every year, but this is just kind of the average that you see. I just wanted to take you through what does corn typically do, or what has been the average move for corn over 30 years with this huge seasonal drop. What's been the average move for soybeans? Quick recap of this week. Same story pretty much from last weekend. Corn and beans continue to slide. As Cy talked about, we have perfect weather and likely big yields. Demand is lagging, and there's just a lot of grain to sell out there. So the markets have just continued to slide as a result. Our models are neutral, so the data that's out there isn't really doesn't give us any conviction one way or another in terms of which way the next move might go, corn and beans, and as a result, the models and the forecasts thrown into our simulations basically say hold. We're pretty close to neutral. Corn's a little oversold at 60% versus the 55% benchmark. Beans are at 55% versus the 55% benchmark. So we're fairly neutral right now, but we're ahead of the game. Corn is tracking to about a 10-cent win versus the benchmark. Beans to about a 5-cent win versus a benchmark. So the simulation is basically just saying, hold here. Let's get more data. Let's get to the end of the month. So with that, I close this episode. Thanks for listening. Thanks for being a subscriber. And again, we'll be back next week with another episode of the AI Cash Grain podcast. Thank you.